Good morning everyone. Good morning Sanjay, good morning Bibhu, good morning. Okay, so in the last class, we had started off with Ind AS 21, that is the effects of changes in foreign exchange rates, and we had covered quite a bit in terms of what we had studied previously, and we saw new concept of functional currency. What do we understand by functional currency? How does it get determined, etc., etc.? We saw that, and then we saw translation of foreign exchange transactions. That was where we had ended. Okay, so now let us come to some of the whatever we had studied. I have tried to populate it in an MCQ form, so you can just do a quick revision of whatever we had done, and after that I think we can continue with today's session. Okay, so I think you should be in a position to do the first question. Second question, foreign should be this, you should be able to do. All of these you should be able to do. Okay, so this is done. This is also okay. I think 9 also you should be able to do. 10, 14. Okay, all right. So let us quickly start as a quick revision of whatever we have done till now. Yes. So question number 1, functional currency is determined primarily based on. Yeah. So please tell me.
Currency of the primary economic environment in which the entity operates.
Yes. Others all agree, right? Bibu? Yes.
Yes.
All right. Next. Which of the following is not an indicator of functional currency? See the options. Which of the following is not an indicator of functional currency?
Currency of the parents reporting.
Yes, you recollect we had studied functional currency. We had primary indicators, secondary indicators. Primary indicators normally the currency in which you determine your selling price. Okay, so we saw the example of Emirates Airlines where it is the dirhams that is influencing the selling price. Also, primary costs like material, labor, overheads, all these costs are determined in which currency, and you add a markup to that currency value. So that also becomes a part of determining your functional currency. So A determines functional currency, B, and then we saw secondary indicators, the currency in which financing is obtained. So D also forms part of that. So C, the currency of the parents reporting has no bearing on the functional currency determination of the subsidiary. So in this case, C becomes your right answer. Are you okay, everyone? Yes?
Yes, sir.
विभू ठीक है?
Yes, sir.
Okay. Leela, I hope you could go through the session previously. Okay. All right. Foreign currency. Question 3. Foreign currency items translated using
Closing rate.
yes. When we say translated, this means it's already recognized, and at the closing rate, you just do a translation. Okay. So translated using the closing. I mean, that is how we typically interpret it. Okay. Non-monetary items carried at historical cost are
Historical rate.
translated using question 4.
Historical rate.
Historical rate. B. Everybody is okay with this?
Yes, sir.
Yes. All right. Non-monetary items carried at fair value. Which rate would you be using?
The rate at the date of recognition of fair value.
Fair value. Good. Exchange differences on settlement of monetary items. Where do you recognize?
Other comprehensive income.
Be careful. Settlement of monetary items. Suppose today I have purchased something in US dollar when the rate is 88 rupees. Tomorrow when I settle, the rate is 90 rupees. So I'm paying 2 rupees extra. Where this 2 rupees will go?
P&L account.
P&L account, not other comprehensive income. Okay. Sanjay, is that okay?
Yes, yes, you got it.
Yeah. So that goes to the P&L. Okay. Next, average rates for translation. You can use it for, can you use it for monetary items only for non-monetary, for income expense, or average rate is not at all permitted under Ind AS 21? What do you guys think?
I think for monetary items only.
Non-monetary items.
For non-monetary or for something else? Bibu, what do you think? A is only for. So average rate, we use it for what? Average rates. What do you mean by average rates? What do we mean by average rates? Average rate means throughout the year how your currency has been moving, they take an average rate of that. Okay, so typically sometimes how we do is we take the rates of each and every day and then we average it out over the number of days. Okay, so that will give you the average rate for that particular period. If you're doing it on a monthly basis, for the month, all the days divided by number of days. Okay, so that will give you the average rate for that month. So average rates, can I use it for monetary items? Answer is no. Can I use it for non-monetary items? They normally go under your monetary goes under closing, non-monetary goes under historical rate. Income expense, you are permitted average rates, right? It's not necessary for you to do it on a we have seen, in fact, that the standard permits you to use an average rate if the fluctuation is not much. So for income and expense items, you can use an average rate. Yes or no? Yeah.
Yes, sir.
Okay. So question number 10, what is a monetary item?
Will be settled in a fixed or determinable number of currency
Yes.
units.
Yes. So Leela, hope you are able to follow. Yes.
Yes, sir.
Will be settled in a fixed or determinable number of currency units. Okay. Which of the question number 14, which is not a monetary item?
Inventory.
Inventory. Yes. Inventory is not a monetary item. Okay. So I think that fairly gives you a perspective of whatever we had done in the previous class. Okay. So now to give you a perspective, we have seen the brief MCQs of what we have done. Okay. Now we have, yes. Could you try this question which I gave you for homework?
Yes.
Bibu, could you try it out?
Yes, sir.
Acha, ठीक है, you could do it, or do you need help from my side?
You did it.
You could do it. Okay. These two questions, this question 4 and the other one. I hope you could do that. So, ठीक है. Then I will proceed further. Okay, so we shall now look into foreign operations. Okay. Very important and something which is partly you have studied and partly it appears to be a little new. So when we talk about foreign operations, activities are based or conducted in a country or currency other than those of the reporting entity. Okay, so for example, suppose I have a holding company H Limited based out of Mumbai. It is having a limited liability company based out of Berlin, where euros is your functional currency. It is having a subsidiary in Sydney, S Private Limited Company. So their Australian dollar becomes your functional currency. It is having a branch office in, let us say, London. Okay, so this is a separate operation. It's not a separate entity, but it is a branch. So there you have the pound sterling that becomes your functional currency. And you also have an investment in an associate, okay, that is AINC, which is based out of New York, where the US dollars is your functional currency. So this is the various manners in which foreign operations can be carried out. It could be through an associate, it could be through a branch office or a division, it could be through setting up a subsidiary, or it could be through setting up a joint venture arrangement, a joint venture or a joint arrangement you could set up. Okay, so all these are foreign operations of H Limited. Okay. Now, if H Limited has to set up these offices, yes, it will not set up out of thin air. H Limited has to introduce a capital, right? You call it capital, you call it as a startup fund, you call it as funds to commence operations, you call it as setup costs, whatever name you give it. But H Limited has to put money in all these places. Yes or no? Yes?
Yes.
So that money which H is going to put for H, the holding company, it is an investment. It is an investment. Where has it invested? It has invested in a foreign operation. So this becomes an investment in a foreign operation. This becomes an investment in a foreign operation. Okay. But as and when the operations start running, automatically it will have cash receipts, it will have cash payments, it will have incomes, it will have expenses getting recorded. Yes or no? Yes or no?
Yes.
So naturally, there will be some profit in respect of each of these entities, in respect of each of these units. Now, when I'm having profits, when I'm having income, when I'm having expenses, ultimately I will be having assets and ultimately I will be having liabilities also. Yes or no? Bolo yaar.
Yes.
Yes. So this net gives you what? Net assets of the foreign operation. Yes or no? Net assets of the Sydney company, net assets of the US company, net assets of the German company. Yes or no? Yes.
Yes.
And as part of assets and liabilities, it will also include investment by H Limited. Yes or no? Yes.
Yes.
See, if I have given an amount for setting up a subsidiary in Sydney, yes, for the Sydney company, it will be an equity contribution. Yes. So equity contribution will be a part of assets, liabilities, and equity all put together. Yes or no?
Yes.
So basically, my investment which I am putting in, so basically, my foreign operation will be investment introduced plus whatever earnings it generates. Yes or no? Plus whatever earnings it generates. Yes. So we call this something as a different name, a net investment in foreign operation. It is a net investment in foreign operation. One is my gross investment. That means I have put in my capital. I have put in my contribution. That becomes your gross investment. Then it carries out certain operations by virtue of which the foreign operation will have to collect money from its receivables or realize the assets, and it has to also pay the money to its vendors, to its capex vendors, etc., etc. So from a net perspective, I am not only making a cash investment, I am also having an interest. I'm also having an interest in the net assets of the foreign operation. Yes or no? Bolo yaar. Yes.
Yes.
And therefore, Ind AS 21 calls it as a net investment in foreign operation. Ind AS 21 calls it as a net investment in foreign operation. Is it okay? Yes.
Yes.
Okay, so now you understood the concept of net investment in foreign operation. Okay, now let us come to our understanding. Okay, see, when we talk about foreign operations, they could be two types. One is dependent, or the other is an independent foreign operation. Have you studied this? कुछ याद है हमको? Yes.
Yes.
Dependent को we used to call it under AS11 as integral operations. Yes, it is integral to the parent setup, and independent would typically be a non-integral operation. This would be a non-integral operation, and this is what you would be studying under AS11. You remember these things? Yes.
Yes.
You remember the terms, that is enough. I'm not saying you remember the concept. Geeta, are you able to recollect these terms? Geeta, Leela, Vibhu, yes?
No, sir.
Oh, okay. No problem. All right. Fine. So now, when you talk about dependent branches, okay, when you talk about dependent branches, we saw the example where I'm just an extension counter of the main entity. So suppose I have H Limited. It sets up a branch in Morocco. I told you, Morocco branch, or even subsidiary, let us assume. Okay. Now, this subsidiary is not carrying out any operations. This subsidiary is only collecting goods and selling it to Morocco customers. Yes or no? Selling it to Morocco customers. Are you able to follow? Yes. Then it will receive the collections and remit it back to H Limited. That is all that happens here. To pay off the salaries of the employees of this subsidiary, money has to come from H Limited. To make any expenditure payment, money has to come from H Limited. It may have a small petty cash to incur day-to-day costs like some electricity, heat, light, water, etc. Some utility cost. That much money it will be having, but otherwise, each and everything will be planned, decided, thought, executed at the head office. The subsidiary will not do anything. There is no autonomy we saw in that case, right? So this is an example of a dependent foreign operation. This is an example of a dependent foreign operation. इसका खुद का कुछ भी नहीं है. It does not have anything of its own. It is just doing the bidding of the parent company which is situated in India. So for all practical purposes, this becomes a dependent branch. This becomes a dependent branch, a very high level of dependence on the Indian parent. It is only an extension arm of the Indian parent with no independent existence of its own. And therefore, technically speaking, the trial balance that comes out here will be nothing but an INR trial balance. See, it could be in Moroccan currency, no problem. But end of the day, what is it? It is an extension of H Limited. H Limited's trial balance will be in INR, and therefore the foreign branch trial balance also will be part of the INR presentation of H Limited's financials. Are you able to follow? Yes, are you able to follow?
Yes.
Yes, sir.
Okay. Now, contrast this with the UK subsidiary, which we had discussed, right? UK subsidiary procures, produces, sells, retains, plans, and capex. Everything is done by the UK subsidiary. And all this is with external customers. Okay. From H Limited, there is only a shared service cost. See, H Limited is having the whole management office, the CFO, the COO, the CEO, the managing director, all these guys who are the heads of this global entity, they are sitting in India. So, therefore, strategically, at least they have a vision for the UK operations. They will spend some time every month closure. The results of the UK subsidiary are analyzed and a direction is given. And if they're going in a good direction, then they will say, all right, you keep it up. And if there is anything we can discuss, we can convene and discuss. Okay. And any major client acquisition, major project that UK will execute, they will get the concurrence of H Limited, but it won't be a direct interference in UK's operations. UK can independently execute with no support required from H Limited. This becomes which case? This becomes an independent operation. Yes or no? Bolo, this becomes an independent operation which has autonomy. Which has autonomy. Yes or no?
Yes, sir.
Yes.
So therefore, will this company have a trial balance? Obviously, yes. It will have equity, it will have reserves, it will have trade payables. If it has taken working capital financing, it will have borrowings, it will have term loans, and then it will have its own provision for tax under the UK laws. In assets, it will have property, plant, equipment. It could be having certain intangible assets. It could be having receivables of its own, loans, advances, payments of taxes in the form of input tax credit that it has, and it could also be having certain prepaid expenses, other current assets, cash and bank balances of its own. All this will be part of the trial balance. Now, this trial balance will be in which currency? This trial balance will be in which currency? Come on, tell me.
Ideally, it should be
Pounds.
in the parent's currency.
Parent currency. Okay. Sanjay, what do you think?
So it would be in pounds.
Pounds. Geeta, Leela, what do you girls think? This trial balance will be in which currency?
In pounds.
Yes.
Pounds only, UK pounds.
Yes.
Yes.
This trial balance will be in GBP. I think Bibu went one step further. Okay. Now, when I am preparing H Limited's standalone financials, mind you. Okay. When I'm preparing standalone financials, will I need to do anything about this trial balance? Answer is no. As long as I have my investment in the UK subsidiary appearing in my books, it is done. Assuming I have no intercompany balances, etc., etc. If there is, we'll do a normal translation and we'll close the matter then and there itself. Okay. But H Limited standalone will typically be in INR. Now, matter ends as far as standalone is over. But when we talk about H Limited's consolidated financial statements, and this is where I draw from Bibu's explanation, I cannot take the GBP trial balance as it is because the currencies are obviously different. Do I have to consolidate the UK subsidiary? Obviously, you have to consolidate. Okay, because it is a subsidiary and you have the reporting requirement of preparing consolidated financials. So when that is there, this trial balance, which is in GBP, has to be converted into a trial balance in INR. And this will then be merged or consolidated with the trial balance of the parent company to give you a consolidated TB, or rather a consolidated set of financial statements. Yes or no? Yes?
Yes, sir.
Yes.
Agreed. Geeta, Leela, do you girls agree? Understood?
Yes, sir.
Yes. All right. So now Now the whole point is, how do I convert? How do I convert this trial balance? Okay, so in a normal trial balance, what all items you will be having? Let us suppose I have a UK subsidiary. Okay, I'm keeping, or a UK branch we can keep. Okay, I'll keep it very simple. Suppose I'm having property, plant, equipment, £1,000, debtors 500, expenses 1,500, sales 2,000, loans 1,000, 3,000, 3,000. Okay. Exchange rates, opening 95, average 100, closing 105. So these are the exchange rates which are available for the UK branch. These are exchange rates which are available for the UK branch. Now, how do I convert? Which rates do I use and for what do I use? Okay, so first one, I have incomes, I have expenses. Okay, incomes and expenses. Ideally for incomes and expenses, I will have to use the spot rate on the date of transaction. But if the variation is not much, you can use the average rate. You can use the average rate for convenience. No harm in that. Okay. Condition is what? Fluctuation should not be excessive. Fluctuation should not be excessive. Okay. Now, suppose I use the average rate and I convert all incomes and expenses to your INR using the average rate. Now it comes to balance sheet, assets and liabilities. Now it comes to balance sheet, assets and liabilities. Okay. See, in the normal course of business, what did we study for assets and liabilities? Monetary items shall be
Closing rate.
translated using which rate? Come on. Monetary items translated using which rate?
Spot rate.
Monetary beta, closing. I'm talking about the closing trial balance. Okay, not when you enter into a transaction. Okay. Monetary items will go at
Closing rate.
closing. Non-monetary items at cost will go at
Historical.
historical. And non-monetary items at fair value will go at
The rate on the date of determination of fair value.
rate on the date of determination of fair value. ये हमारे 3-4 rules हैं which we were following. Now these rules will not be applicable when I'm converting a foreign operation trial balance from the functional currency of it to the functional currency where it gets consolidated. So in simple terms, when I'm converting this UK branch into INR trial balance, those rules which we studied will not apply. And there is a good reason for that. Okay, what is the rule? The rule is very simple, very, very simple. For the balance sheet, whether it is assets, whether it is liabilities, whether it is monetary or non-monetary, or even if you are having an asset or liability which you are measuring at fair value. So basically we covered everything. Assets, liabilities could be monetary, could be non-monetary, could be measured at cost, could be measured at fair value, kuch bhi ho. Whatever be the asset or liability, all of them will be converted at closing rate. All of them will be converted at closing rate. Are you able to follow? Yes?
Yes, sir.
Okay. Now, question should arise. Sir, ऐसा क्यों? Why are you doing this? Okay, जब हमारे बुक्स में जब असेट्स लायबिलिटीज थे तब तो आप बहुत बोलते थे कि मॉनेटरी है कि नहीं चेक करो, नॉन मॉनेटरी चेक करो, फेयर वैल्यूएशन पे है या कॉस्ट पे है वो सब चेक करो। फिर यहां पे क्यों नहीं चेक कर रहे? यू आर इवैल्यूएटिंग इन अ डिटेल्ड मैनर if the Indian company has foreign exchange receivables, foreign exchange payables, etc. for the Indian entity, in respect of foreign exchange transactions, you analyze each and every balance and say if this is a monetary item, closing rate; if this is a non-monetary item, you look at the rate on the date of transaction; if it is at cost; if it is at fair value, rate on the date of recognition of fair value. So complicated rules you have. But when you are talking about a foreign operation, which could be in the nature of branch, subsidiary, whatever it is, you are saying convert everything at closing rate. Why is this duality there? And the answer is very simple. When I talk about an Indian entity, having equity, reserves, uh, inventory, debtors, local, export, creditors, local, import, loans, etc., etc. Okay, incomes, expenses, everything. In this case, what happens is you are operating this entity with the intention to realize or settle the foreign exchange asset or liability in the domestic currency. Okay, क्या मतलब? Suppose if there is a foreign currency receivable of $1,000 in your trial balance, you are having an intention to settle, to get it realized, to collect money from that debtor, and that is why we do a statement at closing IN, at closing exchange rate. Yes or no? Similarly, if there is a payable, my intention for this particular parent entity, which is domiciled in India, having a functional currency of the Indian rupee, the whole intent behind me is to make a payment of the foreign currency vendor. And therefore, the best representative will be the closing rate. Yes or no? Similarly, incomes, expenses pertaining to any import or export transactions, the average rate. Normally, we have already done it on the spot rate, so matter ends there. So in all these cases, when I am in my own trial balance finalizing, I will do all these various exchange rate evaluations because my intention is to settle these transactions. My intention is to settle the open items. Yes. Now, when I talk about a foreign operation, is it your intention to only settle the assets and liabilities, or is your intention genuinely to carry on business in that particular place? What do you think?
Yes, to carry on the business.
Your intention will be to carry on business. Geeta, Leela, are you with me?
Yes,
Yes?
sir.
All right.
Yes,
Your
sir.
intention will be to carry on the business. Your intention is not just collection of money or payments of vendors. It is having a more broad objective. It is having a much larger objective than mere collection of monies. That means what? Your intention, as far as a foreign operation is concerned, is not to close the operation, but it is to ensure a continued sustenance of the operations. That means That means if at all the Indian entity wants to get money from the foreign operation, see, ideally, a foreign operation, whatever money it receives, whatever it pays, whatever net is left, it remains with the foreign entity. It remains with the foreign entity. Why? Because it has to reinvest that amount and carry on the business on a rolling basis. Okay. I'm talking about an independent and autonomous branch, right? So now the point is this, the point is that particular foreign branch or the foreign subsidiary, whatever you call it, that foreign operation is carrying out business to stay in business. And therefore, for the Indian entity, the only way in which it can get money from the foreign operation is by disposal of all the net assets. Yes or no? Bolo yaar.
Yes.
Geeta, Leela, did you follow? Bibu, did you follow?
Yes,
Yes,
sir.
sir. Got
Yes. The only manner in which the Indian parent can get INR from the foreign operation will be when I dispose of the foreign operation. Dispose of matlab kya? I will sell it out to somebody or I will do a piecemeal distribution. I will collect all my receivables, pay all my payables. Okay. I will settle everything. And then whatever money I get, that will then be repatriated to the Indian parent. That will then be repatriated to the Indian parent. But until I settle, until I settle, no monies will flow to the Indian entity apart from, of course, if there is any shared service invoice we saw as a regular debtor creditor transaction, it will be settled. Or if it is a subsidiary and if the Indian entity declares dividend, then that dividend income will go to the Indian entity as a repatriation of funds. But apart from that, there won't be any movement of funds between the Indian entity and the foreign operation. The only time this will happen is when I have to shut shop, shut the foreign operation, close its operations, close the branch, sell the entire branch, get the money and repatriate it to India. Are we able to understand? Yes. Are we able to understand?
Yes.
So therefore, what is the truest representative of the foreign operations net assets? Is it opening rate? Is it average rate? Is it spot rate on the date of transaction? Or is the closing rate a better representative of its INR value? What do you guys think?
Closing rate would be better.
Yes, Geeta, Leela, Bibu, do you understand me?
Yes, sir.
Yes, sir.
Yes, yes. The closing rate is the best representative of the foreign operation because that represents the realizable value of that branch in Indian rupee. And that is why all your assets, all your liabilities, everything, you don't have to even think about it. Just take the trial balance, convert it using the closing rate, and your story ends then and there itself. Okay. So fairly less complicated, fairly lower complications as compared to a regular foreign exchange transactions in the parents. Is it okay? Yes. Yes.
Yes.
So now let us come back to our question. UK branch. Debit, credit. What all I had? Property, plant, equipment, debtors, expenses, sales, loans. Okay. So convert everything using the closing rate. So closing rate is 105 for assets and liabilities. 105, 105, 105. Will I use 105 for everything if this were to be an Indian entity? Answer is no. For property plant equipment, I would be using either the rate on the date of acquisition, or if it is at fair value, rate on the date of recognition of fair value. Okay. So 105, 105, 105. Expenses and sales would typically go at your average rate of 100, 100, 100, right? Yes. Are you able to understand? Bolo yaar.
Yes, yes.
Yes. All right. So 1,500, 1,500. 1,000. 500 and 1,500, right? 8 lakh. 2,000 and 1,000. Are we in sync with each other? Yes.
Yes.
Is anybody having any doubts right now? Girls?
Clear, sir.
No,
Clear,
no
sir.
doubts. All clear. Okay, perfect. So now I have converted this into INR. You tell me, will this trial balance tally?
No.
No. वो होगा नहीं, because you have used different rates. Because you have used different rates. Okay. So 105 plus 150, 255. Okay. So this gives you 3,07,500. Correct me if I'm wrong. Okay. Okay. So this leaves you with 2,500. Am I correct arithmetically? Yes.
Yes, correct, correct.
All right. Now, why is this difference arising?
Due to difference in exchange rates.
Due to different exchange rates. Yes, Geeta?
Yes, sir.
Yes, Leela, agreed. So basically, I have used different currencies exchange rates for translation of different items. Yes. So there is a currency translation difference that is coming out. The currency translation difference comes to 2,500 credit. This currency translation difference, will it be realized or will it remain unrealized until I dispose of the branch?
It will remain unrealized.
It will remain unrealized. So now you tell me, should this go to P&L or should this go somewhere else?
Yes, not to PLN.
Not to
Sir,
P&L.
like in branch accounting in India, we have that we had make a reserve, foreign currency translation reserve.
वही
Will
वही
we
उसी
make
में आ रहे
that
हैं.
here also?
उसी में आ रहे हैं, हम वही बनाएंगे. Yes, Bibu, we are going to do that. But I want to explain why it is an FCTR. Okay. First of all, it came on account of different currency translation rates. So CT हो गया, foreign currency translation. And because it is not getting realized, हम उसको बिठाएंगे एक अलग reserve में. This goes to FCTR. Is it okay? Yes. The baby is born, you gave a name to it. How does it grow? How does it grow in future? ठीक है. You tell me, will this foreign currency reserve be realized at any point of time or will it remain unrealized throughout?
Sir, it will be unrealized until I think the disposal of the company.
Absolutely. This FCTR will remain unrealized as long as the operations continue. But the moment you decide, I want to close my operations, whatever be the reason, I'm not doing well could be one. I have done so much well. I have taken everything from this place. Now I want to exit the market. Whatever be the reason, the moment you decide to shut the shop, will I realize this FCTR? Answer is yes. You will get this FCTR back. So now you tell me, even though it is sitting in reserve, is there a possibility of this unrealized reserve getting realized at some point of time in the future? Come on. Is there a possibility of this reserve getting realized at some point in future? There is. On shutting the branch or shutting the subsidiary or closing or liquidating, there is a 200% possibility that you are going to realize this reserve. It may be more than 2,500, it may be less than 2,500, whatever it is. But there is a strong certainty that this reserve will get realized. So now you tell me, should it go directly to my reserves and surplus, or should I route it through other comprehensive income? Bolo yaar. Come on. See, reserves can come out of two places, right? See, if I talk about a revaluation reserve that you create, right? How do you create a revaluation reserve? When you revalue your assets, you directly take it to reval reserve. Yes or no?
Yes,
Yes.
sir.
You don't route it through OCI. You directly take it to revaluation reserve, number one. Number two, we saw in the case of employee benefits. Unfortunately, I only taught you, right? In the case of employee benefits, change in actuarial assumptions. Where do you record that? The gains or losses arising due to actuarial remeasurement that goes to OCI as a non-reclassifiable OCI, and from OCI it moves straight away into your reserves. Yes or no?
Yes, sir.
Now
And
you
not said
tell.
unfortunately, sir. It's fortunately.
All right, fine. That is a way of telling, right? Now, coming to FCTR. Should I show directly in my reserves? Number one. So I'm giving you options. Now you tell me. Directly reserves. Number two. OCI non-reclassifiable. Straight from OCI, it will move to reserves. Third one, P&L, regular, income, expense. Fourth one, OCI, reclassifiable. Where do you think FCTR should fit? Will it fit under number one? If it fits in one, it implies that this reserve is never going to be realized. Will that happen? Answer is no. This reserve will be realized. It will be realized at the time of closure of the branch. So reserve directly nahi jayega ye. Okay. Will I treat it as OCI, which is non-reclassifiable to reserves? Answer is again no. This gets realized. This is very much in the control of the entity. So therefore, it cannot be part of a non-reclassifiable item. Will it be treated in the P&L as a regular income and expense? Answer is no. This is arising out of a translation of the viable item loss that is sitting in your other comprehensive income that will flow back to your P&L as a realized gain or
Non-reclassifiable reserves and
non-reclassifiable
reclassifiable.
मतलब क्या होता है? See, we studied actuarial remeasurements, right? In actuarial remeasurement, we got gains or losses, correct? Where do I recognize those gains or losses? I would recognize it in your P&L in other comprehensive income, correct? From other comprehensive income, it would never. You are able to follow?
Yes.
Yes. तो उसका इम्पैक्ट P&L में कभी नहीं आएगा. बट दिस फॉरेन करेंसी रिजर्व विल योर EPS इज मतलब आफ्टर टैक्स बट बिफोर अदर कॉम्प्रिहेंसिव इनकम एडजस्टमेंट्स. इज इट ओके? यस, बिकॉज योर
Yes.
अदर कॉम्प्रिहेंसिव इनकम, for example, fair value movements on equity instruments. If you take that option of fair valuation and you want to do it through OCI, you want to keep your operational P&L free of market movements, you can take it in OCI. I'm just giving you examples. Okay. These two. Then FCTR. this will go and sit in OCI because it is not yet realized. But the year in which it is realized from and surplus. Is it okay? Yes.
Yes. Yes.
Did you understand the reasoning behind all this?
Sir.
Yes, sir.
Yes. See, don't by heart. By now, I think you would be fairly aware of the reason why the treatment is even simple. It is even more simple. Okay, you don't really have to worry. All income expense take average rate. All assets liabilities take the closing rate. All assets and liabilities take the closing rate. Because of different rates, your trial balance will not tally. The differential, where does it go? The differential goes and sits in a reserve known as foreign currency translation. Operation is continuing. The moment you decide to close the operation, FCTR will get realized because you will sell off assets, settle the liabilities, you'll be left with some profit, which will include the FCTR component also. So what will happen is FCTR, I will show it under other comprehensive income. And from OCI, we will reclassify to the P&L on disposal of the foreign operation. And from there, it goes to retained earnings. Are we okay with this? Yes, are we okay?
Yes. Yes.
Perfectly, sir.
Yes, this was typically, I gave you an example of a foreign branch because there you get connected easily. But suppose you are a subsidiary, right? Now, foreign subsidiary, is it typical Schedule 3 balance sheet and all, just a regular thing to give you idea what all could be there, okay? Trade payables, provisions, property, plant, equipment, inventory, trade receivables, other current assets, DTA, DTL. Okay, so all these things put together will form part of the not branch now. This will be a US subsidiary. Are you able to understand? Yes.
Yes.
All right. Now, for the foreign subsidiary, if I have to convert this trial balance, you will be absolutely fine to convert all these items. Yes, all these items, straight away the standard says apply the closing rate, finish it off. You will have a problem in equity share capital and reserves and surplus. Sir, problem क्यों हम उसको भी convert कर देंगे ना closing rate में, क्या फर्क पड़ता है? We will do everything at closing rate. P&L एक आप average rate बोले, ठीक है हम average rate पे कर देंगे, but everything we will do at closing rate. ऐसा नहीं हो सकता. It cannot happen like this. Why? You remember we had done Ind AS 102? Yes? Yes?
Yes, sir.
All right. In days 102 में, we had studied two instruments. One was ESOP and the other was SARS. Do you remember this?
Yes.
Yes. ESOPs में what I used to do? I would measure at fair value at grant date. Yes?
Yes, sir.
Correct? Stock appreciation rights, remeasure at closing fair value. Yes or no?
Yes.
The difference would go to the P&L. Why was I not remeasuring ESOPs? मैं ESOPs क्यों remeasure नहीं करता था? Because own equity cannot be
Remeasured.
remeasured. You remember I had made this statement long time ago.
Yes,
Yes.
sir.
मैंने बताया था, I think exactly 1 month back. Yes, 30th September we had started, right? So
Yes.
yes, so we had made this discussion. Apply the same principle here. Own equity cannot be remeasured. That means what? your equity share capital and reserves, which is in foreign currency, every end of the year, you cannot remeasure it using the closing rate. It is not financially correct. Yes or no? Do you agree to this? Geeta, Leela, Sanjay, Vibhu, do you agree to this?
Yes.
Yes, sir.
Yes.
Yes,
Bola
sir.
karo, you need not even mute yourself if that is fine with me. Okay, but I want you to understand. So, first point is you understand the problem. You cannot, all this will be in dollars. I hope you are able to understand. It's a US subsidiary. Everything will be denominated in dollars. So, from dollars, you are converting to INR. So, assets, liabilities, you will do. Problem comes with equity and reserves. Equity reserves you cannot change using the closing rate. Okay, you cannot change using the closing rate. Okay. Now, then what rate should I use? Then what rate should I use? Okay. This equity capital, books of parent, it will be investment in subsidiary. Yes or no?
Yes.
Bibhu, Geeta,
Yes, sir.
if parent has invested in subsidiary, that investment only will be the equity share capital for the subsidiary. Yes. And therefore, my equity capital, we will be converting using the original rate on the date of acquisition. Using the original rate on the date of acquisition. Yes or no? Okay. All right. Consolidation, you people have not yet studied, I presume. Yes?
Not studied.
Okay.
Sir, we
But
haven't
if,
studied.
but थोड़ा सा तो पढ़े होगे. In intermediate, you have studied AS
Entered,
21.
yes.
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 हाँ सर,
हाँ.
पूरा
Geeta
पढ़ा
and
था.
ठीक है. Geeta and Leela, you have studied consolidation, right?
Yes, sir.
Okay. Fine.
Yes.
I will not touch into lot of details. Okay. I will touch only into basic things. Okay. This reserve, typically, assuming you have purchased the subsidiary, you have not incorporated it. Assuming you have purchased the subsidiary, there would be some reserves on the date of acquisition. Yes. See, suppose आप चला रहे हो, there is an independent entity which is running a foreign subsidiary. आप बीच में आ गए and you buy a controlling stake in that foreign subsidiary. Yes or no? ऐसा हो
Yes.
सकता है?
Yes, sir.
Yes, this is possible. Now, if you are purchasing a stake of an already incorporated entity, कुछ हो ना हो, that entity will have reserves and surplus.
Yes, definitely.
Yes. वो लॉस हो, प्रॉफिट हो, कुछ भी हो, it will have a reserve and surplus balance. We call that as pre-acquisition reserves. Do you remember this?
Yes.
You would have studied when you were doing consolidation. We call this as pre-acquisition reserves. After you acquire, the entity will still start running, generating profits or losses, whatever you call it, it will generate. Yes or no?
Yes.
So when you acquire a controlling stake and then it starts making profits or losses, those profits or losses will go and sit in reserves. Those reserves will be called as post-acquisition reserves. Yes or no? Bolo yaar.
Yes.
Yes,
Yes.
sir.
Yes? Acha. Now, let us come to a very simple understanding. Okay. when I invest, when the parent invests in a subsidiary, what is it actually getting? It is getting control. It is getting control of the entity. Yes or no?
Yes.
Correct? When it is getting control of that entity, essentially what does it mean? It is getting a control over the net assets of that entity. Yes or no? Bolo yaar.
Yes.
Yes. When it is getting control over net assets of that entity, another synonym, similar term for net assets, can I say it is net worth? Yes. Can I call
Yes.
it as net worth?
Yes.
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 And you have studied right from foundation or even before that the fundamental equation equity plus liabilities is equal to assets. Have you studied this? Yes.
Yes.
ये
Yes,
तो
sir.
बैलेंस शीट है. Equity is nothing but equity share capital plus reserves plus liability is equal to assets. Yes.
Yes.
That means equity share capital plus reserves is equal to assets minus liabilities. Yes.
Yes.
Everybody is in this. Assets minus liabilities, we call it as net assets. Yes.
Yes. Yes.
And these net assets, we also call it as net worth. Yes or no?
Yes.
So basically, when I acquire an entity, when I get a controlling stake in an entity, I pay for the net worth. Whatever percentage, if I am getting 75%, I will pay something to compare with that 75%, whatever it is. Okay. So now, the day I invest in that company, am I getting only equity shares? Or along with equity share, a proportion of reserves and surplus also is coming along with that equity. What do you think?
Yes.
Bolo?
Reserves and surplus proportion comes along.
It will come. Yes. So therefore, can I say that I am on the date of acquisition not only getting some stake of equity capital, physically, yes, you are getting physical shares credited to your account. But from a reporting perspective or from a conceptual perspective, I'm also purchasing these reserves. Yes.
Yes.
Yes, sir.
And because I am purchasing these reserves, can I say the treatment will be the same as the equity capital which I have purchased? That
Yes.
means if I'm converting equity capital at the rate on the date of acquisition, similarly, the pre-acquisition reserves also I should convert using the original rate on the date of acquisition. Yes or no?
Yes.
Bolo yaar.
Yes, sir.
Yes. Leela, are you able to follow?
Yes, sir. Following.
Following? Sure. Anywhere you have a doubt, please let me know. Okay?
Sure,
Yes.
sir.
Okay, don't hesitate because this is something which is totally not new, but something which you are getting exposed to slightly before your consolidation chapter. Okay, so it is something which is getting exposed, but it is fine. आज नहीं तो कल you will study consolidation. Okay, so pre-acquisition reserves will be converted using the original rate on the date of acquisition. Okay. Post-acquisition reserves, are you purchasing them or are you earning them?
Earning them.
You are earning them. So when you are earning, which rate will you use to convert? इनकम एक्सपेंस के लिए कौन सा
Yes,
रेट ले रहे हो?
average rate.
So post acquisition reserve is nothing but income minus expense after acquisition. Yes or no? So they will also be converted using
Average rate.
average rates. Yes. Yes. These are earned reserves. Are you able to follow?
Yes, sir.
Yes.
Yes.
Perfect. All right. This was the most complicated part. Okay. यही था most complicated. Okay. If you have understood this, then be sure you will not be stuck anywhere. You will not be stuck anywhere. Okay. Now, let us move on to the next. If I do this conversion, will my trial balance directly tally, or will there be a difference in the foreign subsidiary trial balance which is converted into INR? What do you think?
Difference.
I think there will be a difference. There
There
will be a
will be
difference.
a difference. There has to be a difference. If there is no difference, you have not followed the rule correctly. Why there will be a difference? Because assets, liabilities, you are converting using closing rate. Equity capital, you are converting using the rate on the date of acquisition. Reserves, pre-acquisition reserves, you are converting using original rate on the date of acquisition. Post-acquisition reserves, you will be converting using average rate, which you have generated these reserves, right? So because you're using different rate for different blocks of the trial balance after the conversion will not tally. It will show a difference. It will show some difference. This difference is again nothing but foreign currency translation reserve. This is nothing but foreign currency translation reserve. Are we okay with this?
Yes, sir.
Yes. Any doubts? No doubts? Okay. Now, FCTR, Foreign Currency Translation Reserve. This FCTR, will it be post acquisition reserve, or will it be a pre-acquisition reserve, or will I have to do an analysis? What do you think?
We'll have to do analysis, sir, when
Okay.
we acquire.
ठीक है, fine. Now let me explain. Okay. Suppose date of acquisition 1/4/2024. Okay. On this date, let us suppose the balance sheet looks something like this. Okay, I'm doing a simple balance sheet. My intention is to explain the concept. Okay. Suppose I have, this is the balance sheet in dollars. Okay. अच्छे से लिखो, balance sheet in USD. Okay. Equity share capital 500, P&L 500, loan 500, property plant equipment 1000, debtors 500. Okay, this is balance sheet on the date of acquisition. Okay, this is your balance sheet on the date of acquisition. Now, let us suppose I have to, now this is the date I purchased the company. This is the date I purchased the company. On 1st April 2024, I have purchased the company. Suppose on this date, the US dollar rate is 1 USD equal to rupees 80. On this date itself, if I have to convert it into INR on 1/4/2024, if on this date only I have to convert it into rupees, what rate will I apply for equity share capital? Bolo?
Date of acquisition.
What is the date of acquisition? 1st April 24. So which rate will you apply? You will apply 80 rupees. Yes or no?
80 rupees.
So equity share capital 80. So 80 into 500, 40,000. Correct? P and L. This 500, is it in existence on the date of acquisition? Answer is yes. You purchased on 1st
Yes.
April 2024, reserves were already there. So this becomes what? Pre or post acquisition reserve?
Pre-acquisition.
Pre-acquisition. So you will use the rate on the date of acquisition.
Date of
Rate on
acquisition.
the date of
Yes.
acquisition is 80. So again, this will be 40,000. Yes? Correct?
Yes.
Now we move on to loan. Loans have to be converted using which rate? Closing rate. Closing rate is again 80 rupees because I am converting on 1st April 2024. Yes or no? Yes? बोलो.
Okay. Yes.
आई एम कन्वर्टिंग
Yes.
ऑन 1st April. अभी 31st मार्च आया नहीं है. अभी हम कन्वर्जन कर रहे हैं ऑन 1st April itself. So on 1st April, the rate is 80. So 80 into 500 will again be 40,000. Similarly, PPE also I will use 80. So that becomes 80,000 and debtors again will be 80. So this will be 40,000. So can I say that on the date of acquisition, my balance sheet or trial balance perfectly tallies? Yes.
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 It will always tally. It's not only in this case. It's not a miracle I performed. It is pure logic. On the date of acquisition, you convert everything into INR. एक ही रेट होगा ना आपके पास. Yes or no? If I want to convert the foreign subsidiary into Indian rupees on the date of acquisition, तो date of acquisition पे एक ही रेट होगा ना आपके पास. Yes or no?
Yes.
बोलो यार,
Yes,
because
yes.
that is just the first day of acquisition. Yes, अभी कुछ भी नहीं हुआ है. You just purchased, you signed the shareholders agreement, you got the controlling stake. उस दिन पे आप balance sheet convert करोगे. If you are converting the balance sheet on the date when you signed the share purchase agreement, there is only one exchange rate in force, which is the rate on the date of acquisition. And because there is only one exchange rate in force, on 1st April 2024, your trial balance will perfectly tally. FCTR will never arise. FCTR will never arise. Are you able to follow? Yes.
Yes.
On 2nd April, just the next day, will your position be the same? On the second day, will your position be the same? Answer is no.
No, it will change.
Suppose you don't do any operation. On 2nd April, आप फर्स्ट को क्या किए थे वही किया. आप आए, you just sat and went back. Operationally, nothing has happened. But on 2nd April, exchange rates will be different. Yes.
Yes.
So let us suppose, I'm keeping it simple for you. Let us suppose on 2nd April, same balance sheet, no operational changes. But on 2nd April, your exchange rate, let us suppose it is 81 rupees. Okay, let us suppose it is 81. So 81 into 500 gives you 40,500. And here debtors also will go at 81. So this is 40,500. Property, plant, equipment will also go at 81. So this comes to 81,000. Are you able to understand? Yes.
Yes.
Girls,
Yes, sir.
Bibhu, Leela is able to follow?
Yes, sir. Following.
Okay. So 1 lakh can I say that this is 121,500? Can I say that now there is a difference of 1,000 in the trial balance?
Yes.
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 What will be this difference? This difference will be FCTR. When is this FCTR arising? It is getting born on 2nd April. It was not there on 1st April. It is born on 2nd April. 2nd April, were you in control of the subsidiary or not in control of the subsidiary?
Yes.
You were having control of subsidiary, and therefore FCTR kya hoga? This will be post acquisition reserve. Yes or no? Yes.
Yes.
Wholeheartedly everybody agrees. Geeta, Leela, Vibhu, yes. So you have to analyze all reserves, no doubt about it. Even FCTR you have to analyze, no doubt about it. But analysis का outcome क्या है? Any reserve will have pre and post. FCTR will always be a post acquisition reserve. Is it okay? Yes.
Okay, sir.
FCTR is always a post acquisition reserve for consolidation purposes. Are you able to understand this? Yes. ठीक है?
Yes.
Girls, any doubts? No doubts? All clear? Okay,
Yes, sir. Clear.
fine. Okay. Now, suppose I'm just extending this further and further. Okay. Now, we shall take the same position on 31st March 2025. एक साल बाद. Yes, 1 year later. Okay. Exchange rate equals 90. Income equals expenses. Therefore, no profit. Is it okay? Yes. Reserves may nothing is added because whatever you have earned, you have spent that much. Okay. That means your equity share capital, I will convert at 80. So 80 into 500, 40,000. Reserves, opening reserves only will remain because current year reserves is 0. Current year profit is 0. So nothing will be added. So this will be 40,000. And then you have a loan balance. Loan balance will come at 90. So 90 into 500, 45,000. Property, plant, equipment, 90 into 1,000, 90,000. Debtors will be stated at 90, 45,000. Are we all together? Yes. Bolo
Yes.
yaar.
Yes, sir.
So this gives you 1,35,000. 1,35,000. So you are left with 10,000 as FCTR. Any doubts so far?
No.
Any
Clear.
doubts on the
Yes, sir.
conversion? No doubts? Yes. So let us move further. अच्छा, ये FCTR will be post acquisition reserve. ठीक है? This FCTR will be post acquisition reserve. Now, why is FCTR arising? Why is FCTR arising? Because of of the fact that I am very rigid on conversion of two items. I am very rigid on conversion of two items. That is my share capital and opening reserves. I am very rigid on this. Otherwise, my post-acquisition profits also I am using average rates. So, opening at the rate on date of acquisition, opening pre-acquisition reserves, rate on date of acquisition, current year reserves after acquisition using average rate. These three factors or these three items are extremely rigid in their conversion. And because of this, I am also getting that FCTR. I am also getting that foreign currency translation reserve. Okay. Now let us move one step further. Assuming that I have acquired only 90% stake in the entity, 10% a minority guy is there. He is holding the stake. Yes. So is it possible? Yes. Can I have a subsidiary with less than 100% holding? Obviously you can. It's not necessary for you to have a 100% stake. Yes or no? So suppose I have a 90% stake. Suppose I have a 90% stake. Yes or no? So now when you
Yes.
have a 90% stake, 10% there will be a minority interest. Yes.
Yes. Yes.
Now 90% ownership, 10% we call it as NCI, non-controlling interest. We call it in India as NCI. That means your share capital 10% belongs to this fellow, number one. Reserves 10% belongs to this fellow, number two. So now you tell me FCTR, will it belong to the parent or will it belong to parent as well as non-controlling interest? What do you think?
It should belong to both.
It should belong to both. So FCTR again will belong to both parent as well as NCI. Are you able to follow? Because this is the NCI, this is the translation that has come on a foreign subsidiary, and that foreign subsidiary is owned as 90% by the parent and 10% by the non-controlling interest shareholder, and therefore the FCTR relating to that also will go to the non-controlling shareholder. Are you able to follow? Yes.
Yes,
Are
sir.
you able to follow? Yeah.
Yes, sir.
All right. So with that, we kind of conclude the first thing, that is conversion of a consolidated subsidiaries trial balance. Conversion of a consolidated subsidiaries trial balance. Okay. Now we'll get to a question that has this. Again, this question is not a part of your study module. Okay. But I will only be explaining the position in brief. Okay. I'll tell you why. Because I don't want you to get confused with, because I'm not sure how the consolidation will flow in some particular format it will flow. So I don't want to uh, block your minds with the whole consolidation process. What I will do is I will take you through the entire uh, conversion of the foreign subsidiary trial balance into INR. This part I will do. I will stop till goodwill, because that is also one small part which I have to take, because that brings us to one point of discussion. And after that, I will stop. Then when you finish consolidation, when you finish business combination, when you finish consolidation, उस समय पे ये जो आधा क्वेश्चन जिसमें हम ट्रायल बैलेंस को INR में कन्वर्ट करके छोड़ेंगे. From there you pick up consolidation in whatever template you would have studied. Can you do this for me? Yes? Yes?
Yes, sir.
All right. So with this, I think let us start to read the question. This question is not there in the study mat or in what you call RTP में भी नहीं है. Okay, it's not there anywhere. So we shall just run through the question. Okay. All right. Bharat Communications Limited acquired 80% of Ceylon Telecom PLC. It acquired 80% of Ceylon Telecom PLC for rupees 10,40,000 on 1st January 20X5. This is the date of acquisition when the retained reserves of Ceylon Telecom were S rupees 50 lakhs, Sri Lankan rupees 50 lakhs. Okay. So you are given equity share capital, you are given how much have you purchased it for, and you are also given opening reserves. Opening reserves means what? Tell me, this 50 lakhs is already there on the date of acquisition? Yes?
Yes.
That means this becomes what?
Pre-acquisition reserve.
Acquisition reserves. Are you all with me? Yes?
Yes, sir.
All right. Statement of financial position. This is the balance sheet. You are given property, plant, equipment, investment in Ceylon Telecom PLC, current asset, share capital, retained earnings. It is in rupees for the Indian company, in Sri Lankan rupees for the Sri Lankan company. You are given statement of financial position, continued, loans, current liabilities, P&L is given. Okay. In the year ended 31st December 20X5, Ceylon Telecom's total comprehensive income was Sri Lankan rupees 24 lakhs. Sri Lankan rupees 24 lakhs. On 31st December 20X5, Ceylon Telecom paid dividends of 6,90,000. An impairment test conducted at 31st December revealed impairment loss of 2,96,000 Sri Lankan rupees relating to Ceylon PLC's goodwill. No impairment loss had been recognized previously. It is the group policy to translate impairment losses at the closing rate. At the date of acquisition, Bharat Communications chose to measure the NCI in Ceylon Telecom at proportionate share of fair value of net assets. Okay. Statement of changes in equity, you have opening balance, dividends paid, total comprehensive income, closing balance. Exchange rates are given. On 1st January, this is opening. 31st December 20X5, 20X6, this is closing. Average rates of 20X5 and 20X6. Prepare a consolidated balance sheet of the company for the year ending 31st December 20X6. Okay. Okay. I will not proceed till the consolidation, but my key part I will finish so that you will be able to understand better. सबसे पहले, where do I start from? This question, where should I start? Where should I start?
From opening balance sheet.
From opening balance sheet. So this is my opening balance sheet. Everybody agrees? Yes?
Yes.
Oh, wait. This is the closing balance sheet. Okay, 31st December 20X6. यहाँ से start करेंगे. There is no other figure given. Only thing what they have given additional is retained earnings opening was 50 lakhs. Yes or no? Yes. Geeta, Leela, have they given 50 lakhs?
Yes, sir.
So out of 86, 50 lakhs is pre. So post acquisition is 36 lakhs. So we'll see how it progresses. Okay. Now, Okay, I'm just blocking it out so that you are able to see the Sri Lankan numbers first. Okay, all right, fine, then we can rub it out, don't worry. Okay, our first job will be to convert the Sri Lankan trial balance into rupees. That is the starting point. Okay, so first one, share capital 20 lakhs, share capital 20 lakhs. Retained earnings, they have given 86 lakhs, but out of that, they have given pre-acquisition as 50 lakhs. Yes or no? Yes.
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 Then post-acquisition. Post-acquisition, in the year ended 20x5, this is previous year. Total comprehensive income was 24 lakhs. Okay, post acquisition, year 20x5, total was 24 lakhs. Next. On 31st December 20x5, Ceylon Telecom paid dividends of 6 lakh 90,000. So from 24 lakhs, 6 lakh 90 is paid. Yes or no? Yes. Bolo.
Yes.
And then profit or loss for 31st December, it is 27 lakhs. Correct? Yes. So add 27 lakhs. Year 20x6, 27 lakhs. And then somewhere anything is there of dividend. Yes. Dividend paid 6 lakh, 8 lakh 10,000. Are you able to follow? Yes.
Yes, sir.
So minus the dividend paid 8 lakh 10,000. So this is your reserves position. Then you have loans 6 lakhs and current liabilities 16 lakhs. Loans 6 and current liabilities 16. Any doubt so far? 6 and 16. Have I captured everything on the liability side? Below. Yes.
Yes.
Now we move on to asset side. Asset side, there is hardly anything. Okay. 88 lakhs property, plant and equipment, and current assets 40 lakhs. Current assets 40 lakhs. Is it okay? Yeah. So
Yes.
I have captured the Sri Lankan trial balance fully. Now we move on to conversion. Okay. Share capital. Which rate should I use for converting share capital?
For pre-acquisition, the date of acquisition.
Date of acquisition. So date of acquisition is 1st January 20x5, correct?
Yes.
That means I will be using this rate, 9.4. Girls, are you able to follow?
Yes, sir.
Yes. All right. Bibu, all well? Okay. So 9.4, 9.4. These two rates will be used for converting the share capital and pre-acquisition retained earnings. Okay? Yes.
Yes.
All right. So when I convert 20 lakh divided by 9.4, 2 lakh 12,766. Pre-acquisition 50 lakh by 9.4, 5 lakh 31,915. These two are purchased. Okay. Next. Post-acquisition. Post-acquisition. Now this is where it gets interesting. Year 20x5, they got these profits. Am I in control in 20x5?
No.
No or yes? कभी खरीदा भाई शेयर?
1st January 25. Yes.
That means for the year 20x5, were you in control or were you not in control?
Yes, very good. In
You were
control.
in control. So therefore, which rate should I use to convert the profit of 20x5? Yes,
Average rate.
average rate of 20x5, that is 8.8. So, 1 second. Average, sorry, not 8.8, average rate 9.1. Okay. So, 24 lakhs divided by 9.1. Any doubts so far? No doubts. Okay. Next. Dividends paid. On 31st December, TLC paid dividends of 6,90,000. 6,90,000. Okay. Now, 6,90,000 is your dividends paid. Which rate will you convert? डिविडेंड के लिए कौन सा रेट लगाओगे? Yes. Come on.
Average rate.
Think little bit. Put little stress on your head. Dividends paid. Focus on the word paid. You should get your answer. Am I paying these dividends? क्वेश्चन में तो वही दिया है डिविडेंड पेड. तो डिविडेंड पेड मीन्स it is hitting your bank account. Yes. Yes or no?
Yes, sir.
So if it is hitting your bank account, will you take average rate or will you take the rate on that particular day? If it is hitting your bank account, will your bank give you an average rate for debiting your account, or will it use what we say a specific rate on the date of transaction?
Closing rate.
Closing rate. Don't call it as closing rate now. Call it as rate on the date of transaction. It is coincidentally coming on 31st December 20x5, which becomes your closing rate. Is it okay? Yes.
Yes.
So 6 lakh 90 divided by 8.8. Next, year 20x6. Profit earned 27 lakhs, average is 8.4. 27 lakhs, 8.4, 321, 429. And here also I have paid some dividend. Yes, 8 lakh 10,000. So 8 lakh 10 divided by 8.1. So 8 lakh 10 by 8.1, 1 lakh rupees negative. Is it okay? That means these are all payouts. Then all other items we will be converting using the closing rate. So 8.1, 8.1, 8.1, 8.1. We convert everything and arrive at your FCTR of 1,57,205. Anybody has any doubts now? Any doubts on conversions? Yes. Any doubts so far? girls and boys? All clear? Vibhu, Sanjay, Geeta, Leela, what happened? No response? Did you understand or not? No questions. Okay, fine. I presume you have understood. Okay, so 1,57,000 your FCTR gets created, and that is a post acquisition reserve. Okay, teacher. So with this, I will leave this question. Okay, because now beyond this, it will be the domain of consolidation. Let them take you through. Then you can probably come and visit this. Is it okay? Yes.
Yes, okay.
All right. So यहाँ तक this was about Ind AS 21. This was about Ind AS 21. Next. All right. Foreign subsidiary, foreign operations, goodwill. Okay. Right. Now, let us come to our presentation. Okay. So this I have done to the extent it's required for you. Next. Shall we now pick up some easy questions? Yeah.
Yes.
In relation to this conversions only. Just searching where did that question go. Okay. Can you try this question right now? Okay, we'll read the question. Infotech Global has a functional currency of USD, needs to translate its financial statements into the functional and presentation currency of Infotech Inc., which is L dollar. The following balances appear in the books of Infotech Global. Issued capital $50,000, opening retained earnings, profit for the year, accounts payable and liabilities. Property, plant, equipment 50,000, receivables 9,35,000. Translate the above balances of Infotech Global into L dollar ready for consolidation by Infotech Inc. Share capital and opening retained earnings to be taken at L dollar 30,055 and 15,274 respectively. Prepare a working of the cumulative balance of the foreign currency translation reserve. Relevant exchange rates per L dollar are as follows. Rate at beginning of the year 1.22, average 1.175, and at the end of the year 1.13. Yes. So can you try doing this right now? Yes. Draw the trial balance, put the exchange rate, multiply or divide, and that gives you your answer. Okay. Will you try it out?
Yes.
Yes, please try it out. Infotech Global. Try it out. Just give me. Could you do? Yes. Hello.
Yes, sir.
You could try it out.
Trying doing all.
Okay, fine, fine. Do. It's simple. Infotech Global. Okay. Once you are done, let me know.
Can I see the question?
Yes. You got the question? Yeah. This is taken from your study module. Okay. Try it out. I think you should be able to do it. It should not take so long. Leela, Geeta, did you do it?
Yes, sir. Doing.
Okay.
Done, sir.
Done? Okay.
So I did it, but I did wrong. I did not
ठीक है,
divide the rate.
देखें.
I did not divide by the rate. I multiplied by the rates.
Oh,
So I got the wrong answer.
okay. ठीक है, तो अभी डिवाइड कर दो.
Just
What about the girls?
Sir did the same mistake.
अच्छा. Sir, you know, very costly mistakes. You know the concept, but one arithmetical error, and then we go for a toss, right? They have given rates per L dollar. Okay, that means 1 L dollar is equal to USD 1.22. So since your balance sheet is in USD, you have to divide. Okay. So anyways, so with that, I think we shall just run through the solution. Okay. So you are given issued capital, opening retained earnings, profits, accounts payable, accrued liabilities, PPE and receivables. So PPE receivables, they go at the closing rate. You divide it.
Yes.
Issued capital, they have already given the
It's
conversion.
populated, sir.
Uh-huh.
Given, sir, it's
I know,
populated
I
there.
know. Yes. Similarly, opening retained earnings, they have given the converted values. Profit for the year, you take average rates. Payables and liabilities go with the closing rates. So balancing figure 24,376, that becomes your FCTR. That becomes your foreign currency translation reserve.
just
And
got the
if you
answer.
see, and if you see how this FCTR comes, it comes on account of only three things: issued capital, opening retained earnings, profit for
And
the year.
profit.
So these three things are at this values: 30,055, 15,274 and 17,021. If I had to convert that also at the closing rate, it would be 86,726. So the difference of 24,376 is coming in this place. Are we okay with this?
Yes,
Yes, sir.
yes. Now I got the answer.
Got? Okay.
Yes, yes, I did it.
Geeta, Leela, did you get this?
Yes,
Yes,
sir. Got
sir.
it.
Got it? Okay, I see a new guy, Karthik. Yes. If you are following, let me know. Okay, fine. Next. So that closes this question. Same question is there, absolutely same. Okay, so try this out for homework. Okay, only USD has become euros. I mean, it's between euros and USD. Otherwise, everything is same. So this is an examination question. It had come in your May 2019 exam. So you can try this out. Okay. All right, fine. So try this. ठीक है. Now, major part. Okay, fine. Now we come on to. Okay, this is done. Okay. Now, two important concepts are there, and then I think we are done. So, the next important concept that we have is net investment in a foreign operation. Okay, NIFO. Okay, versus intra-group balance. Okay. Now, see, many times, how do I set up these foreign entities? Typically, I will put in equity capital, yes or no? Correct?
Yes, sir.
I will subscribe to the shares, or I will subscribe to the capital, whatever name you want, you call it, or I will subscribe to preference shares, whatever name you want, you can give. Okay. Many times what happens, these subscription of shares, preference shares, debentures, bonds, all these come with lot of regulatory requirements. All these come with lot of regulatory requirements. Okay. If I have to do investment in equity, I have to follow the ODI route. I have to take RBI approval. I have to give all the details where I'm putting, why I'm putting, which location it is, where it is. It's a lot of information that is required. Uske baad bhi, there will be clarifications from RBI, then we have to revert. And once all of that is done and they give an approval, then you have to transfer the money. So in all these cases, it is typically what we call as a legal procedure intensive task. It's not easy. So what sometimes entities do is they give money as a loan. They give money as a loan. That loan has no interest. That loan has no repayment period. वो बस आपके बुक्स में पड़ा है एज लोन गिवन टू सब्सिडियरी एंड फिर वो चल रहा है दैट इज जस्ट कंटिन्यूइंग एज इट इज यस लोन गिवन टू सब्सिडियरी with no repayment terms, with no interest terms. It is just given to fund the operations. So tell me one thing. Is this really money that is going to come back? Or is this something which is having more equity characteristic?
It has more equity
It's
characteristics.
more like equity with an name of loan.
Correct, with the name of a loan. Karthik, Geeta, Leela, are you convinced about this? Yes?
Yes.
Yes, sir.
Sir.
All right. So, to avoid the legal hassles, we do this, okay? Which is fine, okay? Well, there are so many such examples which we have. But the substance is, ये loan है ही नहीं आपके books में. It is more of an equity nature. So, what Ind AS 21 calls it is an item for which settlement is neither planned nor likely to occur in the foreseeable future. By loan hai, you have given a loan, but it is not going to come back in the near future. You don't have plans also to get it back. Money also will not come back. It is neither planned nor likely to occur in the foreseeable future. When will this money mostly come back to you? It will mostly come back when you close the operation. तब तक वो पैसा वहीं पे रहेगा. It will come back to you when you shut operation. Along with that FCTR, this money will also come back. Oh, I got this money back. You will tell only at that point of time. Now you cannot even anticipate when this money will come. So what we call this as, we call it as a part of net investment in foreign operation. Okay. In the standalone financials, it is an advance which is given. It is a loan which is given. Okay. But in reality, the substance is, it is a net investment made in a foreign operation. Example, a short-term loan getting rolled over continuously. Rolled over means 9 महीने के लिए दिया then they make an application, then again you extend for another 11 months, then you extend for 11 months. That extension keeps on continuing. Okay. Regardless of foreign subsidiaries' ability to repay has same effect as that of a capital contribution. So a short-term loan getting rolled over is nothing but similar to a capital contribution, that is similar to equity or long-term receivables or loans. So this becomes NIFO. On the other hand, suppose I gave you the
Sir, when
example.
it become NIFO, will there any effect from
It will
foreign?
come. And that's why I will come to that. I will come to that
Okay, sir. Okay.
once I complete this explanation, because NIFO has a different treatment and intra-group balances has a different treatment. Okay.
Okay, sir. Okay, sir.
Now, we discussed in our example, a shared service charge is put on the subsidiary. Okay. So, when I raise an invoice on the subsidiary, in my books, subsidiary will become receivable. Yes, I will have a receivable from my subsidiary. Yes or no? Bolo, if I sell goods to my
Yes, sir.
subsidiary, if I make a
Yes, sir.
service invoice on my subsidiary,
Yes,
it
sir.
is a receivable. And
Receivable
tell
after.
me, is this a normal receivable? Definitely. It's operational receivable. इसका पैसा आपके subsidiary से आएगा. You will get this money back from your subsidiary. So these are not NIFO. This is just intra-group balance. This is just intra-group balance. Trade receivables, trade payables. Sometimes you give a short-term working capital loan with repayment inbuilt in that. You don't do a rollover. Sometimes you give a term loan for the subsidiary to buy something, but you collect EMIs on it. These are all not typically what I would call NIFO, because these settlements are planned and they are happening, or they are going to happen, or they have already happened. So these items are called as intra-group balances. These are called within the group balances. Okay. This is an item for which settlement is planned or likely to occur in the foreseeable future. So in all, as far as foreign operations are concerned, in the books of the Indian entity, two things are possible. Either NIFO is possible or intra-group balance is possible. तीसरा कुछ भी नहीं है. Either you get the money, in which case it will become intra-group balance, or you do not get the money, you do not expect to get the money, in which case it will become NIFO. You can give it any name in your financials, there is no problem, but your classification is driven by the nature of these balances. Are we okay with this? Yes. Are we okay? Yes. Okay.
Yes.
All right. Now, okay. Mhm. Fine. Now let me just explain to you with the help of an example how the NIFO will function. Okay. And then that should help you get clarity. Okay. Then that once that is done, we can run through the presentations in brief. Okay. Case 1. Parent gives loan to subsidiary repayable after 5 years. $100. Okay. So in parents' standalone financial statements on 31st March 2024, it looks something like this. Share capital, this is in rupees. Okay. Let us suppose share capital is 5,000. Loan monetary. Okay. This is given on 1/1/2024 when the rate was rupees 50. At the balance sheet date 31,324. The rate is rupees 60. I'm taking a big movement so that you can be made aware about it. Okay, so loan monetary item, we convert it using the closing rate. So $100 into rupees 60 per dollar, 6,000. And that will balance is a forex gain. It's not a balance, it is a forex gain. Okay, because when you gave it, it was at 5,000. But when you translated it, it is at 6,000. The difference is a forex gain that goes to your P&L. Are we okay with this? Yes. Are we okay?
Yes,
In
sir.
the books of the subsidiary, how would it appear? In the books of subsidiary's financial statements will be prepared in dollars because it is there outside India. So loan will appear at 100, and assuming it has not spent anything, it will also appear in the bank at 100. There is no need for any restatement or anything because this itself is the functional currency. Any doubts so far? Yes? Any doubts? Any difficulties so far?
No, clear.
All clear. Okay. Now, when I prepare a consolidation, I will start consolidating the subsidiary into the parent. Yes. So when I consolidate, this 100 will be translated at which rate? This 100 will be translated at closing
Closing
rate.
rate.
So 100 will become 6,000 rupees. Correct? Yes.
Yes,
And this will also become 6,000. Correct? Bolo yaar.
correct.
Yes. So now, if I have to, just a second. It's very interesting now. Now, in the consolidated financial statements of the parent. Okay. What will happen to this 6,000 loan which is given? This 6,000 will knock off this 6,000 because it is asset for the parent, liability for the subsidiary. So when I consolidate, asset and liability will cancel out each other. Yes or no? Karthik,
Yes, sir.
Leela, yes. All right. Yes. All right. So this and this will get knocked out. You will have share capital. This will not change. This new bank balance will come of 6,000 rupees, and you will be left with 1,000 of consolidated P&L, which is essentially the foreign exchange difference. Are you able to follow?
Yes, sir.
Yes,
The
Yes, sir.
question is, will that 1,000 of consol P&L balance of 1,000, which is essentially the forex gain, will that appear in the balance sheet or not? What do you think? Should it appear or should
It
it
will
not
appear,
appear?
sir. It will appear, sir.
Yes. And why it should appear?
Because, sir, it's an separate item like that. It's an income.
तो क्या हो गया? मेरे सब्सिडियरी का ही तो पार्ट है. Yes. And when I'm consolidating, parent and subsidiary together I combine. So why should that 1,000 come into picture?
Because the exchange difference is real, sir. It's
Exactly my point. This 1,000 rupees represents what? It represents currency fluctuation. Currency fluctuation is tangible not only from a standalone perspective, but it is tangible from a group perspective. It is tangible from a group perspective. Yes or no? And
yes,
because
sir.
it is tangible from a group perspective, when actually there is a remittance, suppose इसी day पे, suppose on 1st April, let us suppose the rates are not moved immediately on 1st April 2024. Subsidiary remits $100 to the parent. Parent को कितना मिलेगा? Parent will get 5,000 rupees or 6,000 rupees?
Will get 6,000.
Parent will get 6,000. Exactly. Sir, but
1,000 will be
parent when
profit
it gave 5,000. No. When parent gave $100. You converted it into 5,000 because on that day the rate was 50. But when the money came back, sir, I got 6,000. No, you got only $100.
$100, and the
But
difference is in exchange.
yes, the exchange fluctuation has happened, which has credited your bank with 6,000. That means this 1,000 rupees is something which is a tangible, realizable loss which will sit. As on 31st March 24, it is unrealized, no doubt. But when you settle this loan, this unrealized loss will move into a realized loss, regardless of whether it is receivable or payable from the within the group. Is it okay? Yes. Is it
Yes, sir.
okay?
Legit
All right.
okay.
Perfect.
I have a one doubt, sir.
Tell me, Karthik.
सर जैसे हमने अभी कन्वर्ट किया आपने फॉरेक्स तो हमने बुक कर लिया 1000 का
Correct.
बट एट द टाइम ऑफ कंसोलिडेशन जो हमारा ऑपरेशन है दूसरा तो उसका ओसीआई पे हिट नहीं जाएगा क्योंकि अभी भी लोन हमारे बुक्स में तो 5000 पे है बट उनके बुक्स में 6000 पे है
नहीं नहीं, लोन हमारे बुक में 5,000 पे नहीं होगा ना, हमारे बुक्स में भी 6,000 पे होगा ना कार्तिक.
ओके सो बिकॉज वी हैव बुक द
Because we
फॉरेक्स
have to translate it as a monetary item, right?
सो हमने सर इसमें फिर पीएनएल में क्यों हिट लिया क्योंकि अभी भी रियलाइजेबल तो है नहीं हमने इसको ओसीआई में हिट
This
क्यों
is
नहीं किया
realizable. I'm talking about this is a case where it is realizable. Okay.
ओके
Unrealizable, I'm coming to the next case. Okay. Just थोड़ा सा step by step करेंगे. Okay.
ठीक
So this is realizable. Now we come to the next case. Okay. Now we come to the next case, case 2. Everything is same except that P makes, it's not a loan, it is an investment in S of $100. Everything is same. Rates are same. Year is same. Funds transferred also is same, but it is an investment. It is an investment. So now, if I talk about standalone financial statements of P, it looks something like this. Equity share capital 5,000. On the same date, I have made investment in subsidiary 5,000. Correct? This is how it looks. All right. And then in separate financial statement of the subsidiary, it will appear as equity share capital 100 and bank 100. Any doubt so far? This is an investment. This is an investment. This is not a loan. Okay. This is, I'm going with investment. And then the third case, what we will do is we will look at loan which is in the nature of investment. Okay. हम धीरे धीरे करके, so that at the end of the third case, you will be absolutely clear on how the NIFO concept works. Okay. Now, this is on 1st April ही था ना, और we can take 31st March. ठीक है. 1st April को हमने दे दिया. We gave it on 1st April. 31st March, again, very simple case. No movement in P&L, nothing is there. So 31st March को भी यही position है. Now you tell me, on 31st March, the standalone financial statements of the parent. Equity share capital 5,000. Investment in subsidiary. What do I do with the standalone financial statements? Investment in S. Do I restate it or will I leave it at 5,000?
रीस्टेटेड
आप रीस्टेट नहीं करोगे कार्तिक. दिस इज एन इन्वेस्टमेंट मेड इन इक्विटी. दिस इज नॉट अ मॉनेटरी आइटम ना. ये मॉनेटरी आइटम तो नहीं है आपके लिए. यस
ओके ओके
तो आप इसको रीस्टेट नहीं करोगे, आप इसको सिर्फ 5000 लाके छोड़ दोगे इसको. Did you understand everyone? Leela, Geeta, Sanjay, Vibhu, yes? You will not restate it, okay? No restatement. Since it is a non-monetary item. Since it is a non-monetary item. Is it okay? Understood? Yes?
गॉट इट सर.
As far as SFS is there, same will continue. As far as SFS is there, same will continue. Okay. But now the question comes consolidation. Now the question comes consolidated financial statements of parent. Okay. Now here equity share capital will be 5,000. No doubts in this. I kept a very simple case. My investment and this will knock out each other when I consolidate. My investment is equity capital of the subsidiary. Yes or no? So when I consolidate, these two things will knock out. Correct? Correct? Yes?
Yes, correct.
But now just see the standalone financial statements of subsidiary. This, if I convert it into INR, equity share capital, I will convert on the date of acquisition, so 5,000. Bank, I will convert using closing rate. Closing rate was 60 rupees into 100. So bank balance will be 6,000. This is a converted rate. So this difference, what it is? Will it be a foreign exchange gain or will it be an FCTR?
FCTR sir.
This will be an FCTR. This will be an FCTR because this is in the nature of equity. This is in the nature of equity share capital. So this will be a foreign exchange translation reserve of 6,000. Are you able to understand everyone? So when I consolidate, the bank will flow into the CFS at 6,000 and I will be having an FCTR of 1,000 in the consolidated reserves. Are we able to understand this? Yes. Are we able to understand? Yes.
Yes, sir.
So in case 1, there is a foreign exchange gain or loss because that was an intra-group balance. Which balance it was? An intra-group balance where settlement was planned in the next 5 years. It was a monetary item. So the gain or loss, we took it to the foreign exchange gain in the P&L and it sat in the P&L. Even from a group perspective, this is an actual foreign exchange exposure that the group is carrying and therefore carrying that 1,000 rupees as a gain even from a group perspective was perfectly sound and reasonable. In the second case, there is a foreign exchange exposure again, but this foreign exchange exposure will not be realized because this is made as an investment in equity where the equity gets realized only on closure of the entity, which is not planned in the near foreseeable future. And therefore, this difference goes and sits under your foreign currency translation reserve. This goes and sits in your foreign currency translation reserve. The consolidated financial statements in case 1 and the consolidated financial statements in case 2 are exactly the same except for reserves. In the first case, when it was an intra-group balance, the reserve was nothing but your balance in statement of profit and loss because it sat in the P&L as exchange gain. In the second case, it sat in the P&L as zero, but it went and sat in the reserves as a foreign currency translation reserve because money flow is not planned. This money flow will be realized only on closure of the subsidiary and therefore we have parked it into FCTR. We have not taken it into the P&L. Are you clear with both the cases? Everyone? Yes? Bibhu, Karthik, Sanjay, Geeta, Leela.
Yes.
Yes, sir.
All clear? Okay, perfect. And now we come to the last category, that is a combo offer of these two. NIFO is nothing but combine 1 and 2. You have given money. On paper, it is a loan. In reality, it is investment. That is what is NIFO. On paper, it is a loan. In reality, it is investment. You do not want to enter into the realm of compliances. I'm not saying you are evading compliance. Please be mindful. See, if you are an initial setting up entity, you will not want to go to RBI for bring all consultants on board, do your 10,000 filings. The first important thing is what? Setting up an entity. उसके लिए पैसे चाहिए ना, अभी के लिए ले लो. You take and start. See, always remember, business gains preference over compliance. That is what we have to do. I'm not saying evade compliance. I'm saying route your compliances to suit the business. Okay. So in this case, you will give the money as a loan. You will give the money as a loan, but you need to treat it as if you have made an investment, because in reality, it is an investment. In reality, it is an investment. Okay. So case 3 treatment, you will be having a foreign exchange gain of 1000. You will be having a foreign exchange gain of 1000, but that foreign exchange gain of 1000, will it be realized in the near future, or will it be realized only when you shut the subsidiary or the foreign operation? When it will come?
Only on shutting of the subsidiary.
Correct? Karthik, correct? Yes?
Yes, sir, I agree.
That means this amount, this gain of 1000, even though it is on a monetary item, on paper it is a monetary item, even though it is on a monetary item, we will still treat it as an FCTR. We will still treat it as an FCTR, and we will record that through reserves, and it will not go through the P&L, because the investment in this case is of a permanent nature. The investment in this case is of a permanent nature. So what you are going to do is, see, in your standalone financials, it is a loan. It is a loan. So you will have to fulfill that requirement of translation. You will translate it and you show that as a gain when you translate it at the closing rate. Okay, because in standalone financials, FCTR will not come. Okay, because it is a transaction. मैंने पैसे दिए, I gave money to my subsidiary. So it is a monetary item. I will convert it into the closing rate. Gain or loss, I will take it to the P&L. This is a standalone financial. So in SFS of parent, it will look like equity share capital 5,000, loan to subsidiary. This is case 3. Loan to subsidiary 6,000, P&L 1,000. This is forex gain 6,000. Now, in consolidated books of the parent, equity share capital 5,000, bank 6,000. This is of the subsidiary. Now here, I cannot put it as P&L because the group is not going to get exposed to this P&L value. The group as a whole will collect this only on closure of the subsidiary. So what I am going to do is, on consolidation, I will pass the entry P&L balance debit. This is in consolidated books to FCTR. 1,000. P&L balance debit to FCTR 1,000. I will pass this entry and close my consolidation. This is what is the treatment for net investment in foreign operation. You will be treating it as a monetary item. You will take it to the P&L in your standalone financial statements because this is a loan that is given. You follow the transaction in letter in the standalone financial statements. But when you consolidate, the group is not going to collect this, and therefore you show straight away as an FCTR. You show it straight away as an FCTR. Are we okay with this? Yes. Did you understand? Any doubt so far?
Clear.
Karthik, Sanjay, Geeta, Leela.
Clear,
Yes.
sir.
Clear?
Sir.
Okay. Bibhu, Karthik, सब समझ में आ गया ना?
हाँ
Yes.
सर
Yes.
Okay, so we just take a 5 minute break. We shall just continue after that. Just give me 5 minutes. Okay. All right. Fine. Take a 5 minute break. question that why not the exchange gain is taken to OCI than other than the P&L in standalone also, because in consolidation it is depicted correctly. See, in your standalone financials, ultimately there is a regulatory requirement that comes in play, right? See, you have temporarily chosen to give it as a loan. So you cannot negate the fact that this is a loan, right? If you start putting it as an investment, it will start getting regulatory attention. So you did a loan transaction primarily for ease of transaction of the funds. That is why in your standalone, you would prefer to choose it as a monetary item, take it to the P&L. But in console, which is more of a document that is prepared for your reporting purposes only, for that purpose, treating it as a NIFO and moving that gain to FCTR makes correct sense. Is it okay? I hope I have been able to satisfactorily explain. Okay, all right, fine. So now coming to all that we have discussed is there in this presentation. Okay, so if you have not noted anything, it's perfectly fine. Okay, so we discussed what is net investment in a NIFO versus intra-group balances. Okay, so this one in separate individual financial statements as per Ind AS 27. If monetary item is denominated in functional currency of foreign operation, then exchange differences are recognized in P&L of the reporting entity's separate financial statements. What does it mean? See, in our example, I gave the loan in US dollars, right? I gave 100 US dollars as a loan. This 100 US dollars is the functional currency of the foreign subsidiary or the foreign operation. So exchange difference came in whose books? Exchange difference came in the books of the parent entity. So that is what it is telling. If the monetary item is denominated in functional currency of foreign operation, obviously the exchange difference will come in the reporting entity separate financials. If the monetary item is denominated in functional currency of reporting entity, suppose I had to give 5,000 rupees loan, then they would convert it into US dollars and then they would do the conversion, who the foreign operation. So in that case, the exchange differences would go in the foreign operations individual financial statements. Are you able to understand this? Yes, is this okay? Yes, and suppose
Yes.
if I gave the loan in any currency other than INR or in US dollar, suppose I gave it in euros, then I will also have exchange difference and the US foreign operation also will have exchange difference. So in both the currencies, there will be an exchange difference that arises. Is it okay? Yes. So that takes care of this. Where foreign operation is consolidated under equity method, initial recognition, you take it in OCI. On disposal, you move the OCI from equity to P&L. So that is the standard what we have done. Okay. Now, coming to this illustration. Functional currency of parent P is euro. Euro. Functional currency of the subsidiary is dollars. P sells inventory to S, inventory sold at and for $300. At year end, balance of the same amount is outstanding as receivable from subsidiary. It has been observed that such a balance has been continuing as receivable from S year on year, even though payments in respect of these balances are expected to be received in the foreseeable future. But if we look at year end, then we see this balance outstanding every year. So goods were sold from parent to the subsidiary. Every year on year, wo balance is continuing, it's not getting settled. In addition to the trading balance between P and S, P has also lent $500 advance or loan $500. Okay. That is not expected to be repaid in the foreseeable future. Should the exchange difference be recognized in the P&L? So you tell me, what will I do about that 300? That 300 cannot be treated as net investment in foreign operation. It is a trade receivable balance. It has to be treated as a trade receivable balance. Any movement in exchange gain or loss will go to the P&L. The second case, $500, this is going to be treated as net investment in foreign operation. You will treat it in separate financial statements in separate financial statements as profit or loss on translation. In consolidated financial statements, you will treat it in other comprehensive income. Are we okay with this? Yes. Are we okay? Any doubts? Is it clear?
Clear, sir.
Yes, sir.
Yes. All right. Modifying the above, suppose that for tax reasons, the permanent funding extended to S is made via another entity in the group T rather than from P directly. So P gives loan to T, T gives loan to the subsidiary. Earlier, P was giving S directly. Now P gives to T and T gives to S. That is on the directions of P, T gives the loan to S. T is also a subsidiary of P. Correct. So T also is a subsidiary of P. So where should the exchange difference, if any, be recognized? So now again, in consolidated financial statements, it will appear as FCTR. In your separate financial statements, it will continue to be treated in S giving loan to T, you will have one exchange difference. T to S, you will have one exchange difference. But when you consolidate, it will come all of it put together as FCTR. All of it will come together as an FCTR. Are we okay with this? Yes. Are we okay?
Yes.
No doubts. Okay. So approaches to translation. How can I translate? I can translate directly from functional currency to that of the I can translate from foreign currency to functional currency direct, or you can do an intermediate. If there is an intermediary parent, you can do step by step transfer. For example, we have seen cases where Indian company invests in Dubai. Dubai invests in, let us say, Africa. So when I do the translation from Africa to India, because India consolidates, I can do Africa to UAE, UAE to India as two steps, or Africa to India directly as one step also can be done. Okay. So that is your translation. Okay. This we have gone through. Okay. How do I translate? We have already seen assets and liabilities at the exchange rate at reporting date, already done. Results at average rates. Normally, you shall do it at the date of transaction, but average rates may be used if the rates do not fluctuate significantly. All resulting exchange differences booked in foreign currency translation reserve, or you call it as currency translation adjustment. Accumulated balance of FCTR may also include exchange differences from loans that form part of parents' NIFO. Anything different from what we have discussed? This is exactly what we have discussed, right?
Yes, sir.
So no difference. It's the same thing. Okay. Intra-group balances, monetary assets or liabilities, you will eliminate. You will eliminate. Okay. When you consolidate. Okay. But when you consolidate, any exchange difference you will not eliminate. We saw that 1,000 rupees balance that remains as it is because it is a group exposure to the foreign currency. It exposes the reporting entity to a gain or loss through currency fluctuations. So that is why it will continue to come. Okay. Where will I recognize the exchange difference? If it forms part of NIFO, it will go in OCI, accumulated in separate component of equity, that is FCTR, until the disposal of the foreign operation. On disposal, from OCI, you move it to P&L, and from P&L to retained earnings. not part of NIFO, you move it to P&L straight away. Okay, so this also we have seen. All right, so now basis this, I think we can try to do a couple of easy questions. Okay, not something which is very difficult. Okay. The functional and presentation currency of P is US dollars, while that of its subsidiary is euros. P sold goods to S, USD 100. Parent currency is USD and this is euros. At year end, the amount is still due and the exchange rate is $1 equals to euro 2.2. How should the exchange difference, if any, be accounted for in the consolidated financial statements? First of all, tell me, when I sell the goods, entry will be S account debit to sales euros 2, so 200. And when I do a restatement, S debit 2, so that will be 2.2, so that will be 20. The gain will be 20. Where will I take this? P&L. This is my exchange gain. This is my exchange gain. Any doubts so far? Any doubts?
No.
This will be treated as exchange gain because it is ultimately what we call related to your intra-group transactions. It's not related to NIFO. So you take it to the P&L. Even on a consolidated basis, because this is an exposure of the group to foreign currency fluctuation. Okay, so that is done. Next. Next. I would suggest you try this out for homework. Okay. You can try this out for. Okay, fine. Now this one. All right, fine. Entity A, whose functional currency is the rupee, has a foreign operation B. So A has an operation B. This is INR and B has a euro functional currency. Entity B issues a perpetual debt to A. Perpetual debt, that is, it has no maturity. Redeemable है ही नहीं वो. There is no maturity. There will only be infinite interest streams denominated in euros with an annual interest rate of 6%. The perpetual debt has no issuer call option or holder put option. So holder put means the parent is holding the instrument. It cannot sell it. The issuer cannot call, cannot get the instrument back. Once issued, it will be there forever. In A's consolidated financial statements, can the perpetual debt be considered as a monetary item for which settlement is neither planned nor recorded, is neither planned nor likely to occur in the foreseeable future? What do you think? What do you think? Can it be treated as NIFO? Bolo?
Yes,
Yes,
sir.
obviously. Bhai, this is a loan. It is a one-way loan. I give and I don't get. It's a one-way loan. Okay. I give a loan and then सामने वाले को कभी देने की जरूरत ही नहीं है. लेके रहो बस उसी में. All right. So it is actually in the nature of capital. It is actually in the nature of capital. You can treat it as NIFO. You can treat it as NIFO. Okay. All right. So that takes care of that part. And then this week you can try it out for homework. Okay. Next. See, I would want to discuss this question, but you guys are still on consolidation. So I will not touch this because this is related to goodwill and all those things. So once you get that, you can do this. So probably when you have your LVRC revisionary sessions that happen, that time probably we can take up these questions because by then you will have a total view of the standards. Then you can link properly. Okay. All right, fine. So that takes care of this. Okay. Now, this is the latest RTP, Jan 2026 RTP for Jan 26 exam. Parent A Limited is the reporting entity that is having NIFO in two foreign subsidiaries, B and C. So A Limited has B and C. Okay. In all the following scenarios, loans made between group entities are permanent in nature. Settlement is neither planned nor likely to occur. That means it is a NIFO case. Yes or no? It is a NIFO case. Scenario 1. Parent A with pound sterling as its functional currency preparing its financials to March 20x5. It has a loan receivable. Loan is equal to USD 1 million. USD 1 million from its subsidiary C Limited that has been outstanding for some time. Parent notified the subsidiary at the beginning of the financial year that no repayment of the amount will be requested for the foreseeable future. The relevant exchange rates are as follows. Closing rate 1.82. Opening rate is last year's closing rate is 1.45. In scenario 2, facts are same as in above scenario 1, except that A has a loan receivable of 200,000 pounds. This is denominated in the currency of the parent. Okay. The loan is treated by A Limited as forming part of its net investment in C Limited. Required, discuss the treatment of exchange differences in standalone of both subsidiary and parent and in consolidated financials of the parent under both the scenarios. Okay. All right. Now see. Very simple question, not at all a problem. Okay, scenario 1 क्या था? Loan of $1 million given to B. Okay, and these are the exchange rates. So now closing exchange rate, this is the balance 549,450. Opening exchange rate, it was 689. So currently there is an exchange loss of 1,40,205. Currently there is an exchange loss of 1,40,205. In A Limited separate financial statements, treat it as a monetary item with the exchange difference taken to P&L. Exactly what we discussed. On consolidation, the retranslated loan is treated as part of NIFO. So the exchange loss is recognized in FCTR. My suggestion, you write the same language that is there, is recognized in other comprehensive income and accumulated as a separate component of equity. That much you write as per Ind AS 21. Para number देने की जरूरत नहीं है, but you mention this because the language will matter in your answer presentation. Okay. Next, there would also be a corresponding exchange gain for other items, okay, arising as part of retranslation of the net assets. So this is other items which include the US dollar. Okay, that is fine. Okay, in the second case, in the financial statements of individual entities, the following exchange differences will arise. Parent, in this case, the loan is in pounds, right? Look at the question. The loan is in pounds. So therefore, A Limited ka, that is the functional currency. So there won't be any exchange difference, no exchange difference. But in subsidiary C Limited, this exchange loss of 74,000 is recognized in C Limited's income statement because it is exposed to foreign currency risk. On consolidation, you treat it as exchange loss of 40,000 is recognized in other comprehensive income as a separate component of equity. in the consolidated financial statements. Are you able to understand? Yes. Are you able to follow?
Yes, sir.
Karthik, Geeta, Leela, are we able to follow?
Yes, sir.
Yes.
So fairly simple. I think NIFO you people are getting a hang of, right? You are able to understand NIFO. Okay. All right. Now we just move on. This questions we did. Okay. Now disposal of foreign operations. You can have two disposals. Either you dispose entire interest, that means sab kuch sell kar do, you sell everything, or you dispose of partly. That means I was holding 100%, now I may hold 80, I may hold 70, I may own 40, whatever it is. Okay. You can dispose of by sale, liquidation, repayment, or abandonment, whatever it is. Write down of the carrying amount is not a disposal because that is an impairment. That is an impairment. Okay. Cases where partial disposal is equal to disposal, where loss of subsidiary, regardless of whether entity retains NCI after partial disposal, and retained interest is a financial asset. Okay, ye pad lena, it just for your understanding. Okay. When I dispose of an entire foreign operation, the cumulative amount of exchange differences, which was in other comprehensive income, that is foreign currency translation reserve, whatever FCTR is there related to that foreign operation, that shall be reclassified from equity to P&L as a reclass adjustment when the gain or loss is recognized. So basically, FCTR moves to P&L, moves to retained earnings, because now the unrealized profit is now getting realized. Disposal of a subsidiary, that includes a foreign operation. I disposed of a subsidiary. That subsidiary has a foreign operation. So that subsidiary would be having, there would be an FCTR on that. The cumulative amount of the exchange differences relating to that foreign operation that has been attributed to NCI shall be de-recognized but not reclassified to P&L. Okay. Partial disposal, proportionate share, you shall reattribute it to NCI. Any other disposal, proportionate share of the exchange differences, you shall reclassify it to the P&L. Okay, so all this is what is your treatment. So now with this background, let us come to this. See, see, parent P owns 100% of the foreign subsidiary S. Parent sells 70% of its investment and loses the control of the subsidiary. Explain the accounting treatment. What will you do? Entire balance in FCTR is reclassified to P&L because now you no longer have interest. So partial, this is not a partial disposal. This is basically full disposal. You have lost control over the entity. So you recognize everything in the P&L by reclassification. Parent 4 and 5, example 4 and 5, parent P owns 100% of subsidiary S. Parent sells 10% of its investment and retains control over S. Out of 100, 10 is gone, but is it a disposal? Answer is no. This is a partial disposal. How would I recognize it? Well, 10% of FCTR is reclassified to NCI. NCI is the minority interest. Because you have surrendered 10% shareholding, 10% of NCI also, 10% of FCTR also will go to NCI. Are we able to follow? Yes. Yes.
Yes.
Yes, sir.
Okay. So, and example 5, parent owns 35% of associate B. This is not a parent subsidiary. This is a associate relationship. Parent sells a 5% stake and retains significant influence over B. Explain the accounting treatment. So, proportionate FCTR you shall reclassify to P&L. There is an FCTR, that FCTR. Now, here it won't go to NCI because you are the NCI here. Okay. So, you will not reclassify to NCI. You will straight away reclassify 1/7. From 35, you became 30. That means 5 upon 35. 1/7 you lost. So, that you will take it to the P&L directly. Okay, so that takes care of these three examples. Okay, next. Mm, treatment. Okay, fine. All right. So now parent P acquired 90% of subsidiary some years ago. P now sells entire investment for 1,500 lakhs. So sale consideration 1,500. The net assets of S are 1,000 and the NCI in subsidiary is 100 lakhs. So when I sell the subsidiary, net assets also will go out. So minus 1,000. NCI is a credit in your books, so you will add that is going out. So NCI you will add 100. Foreign currency translation reserve. The cumulative exchange differences are gains of 200 lakhs, resulting in P's FCTR in respect of S having a credit of 180 lakhs. That will go, while the cumulative of exchange differences attributed to NCI is 20 lakhs. So 180 lakhs will come as your income. So when you do the netting off, that will amount to gain on disposal of 780 lakh rupees. Okay, so straightforward question. There is nothing that we need to do. Okay, so selling value 1,500, net assets 1,000. So you are left with 500. Now, cumulative exchange differences that have arisen are gains of 200, resulting in FCTR of S having a credit balance of 180, and NCI also will go away. So NCI will credit that will vanish. So total is 780 gain. Are we able to understand? Yes. Are we able to follow? Any doubts? No doubts? All right, you can try this out for homework. Okay, next, quick points. Change in functional currency. Tell me one thing. Functional currency, is it a choice or is it mandatory?
Mandatory, sir.
Mandatory. That means what? This functional currency change will be treated as an accounting policy change. The choice of presentation currency represents an accounting policy, and any change you shall apply retrospectively. That means आपने Ind AS में पढ़ा था ना, you have studied in Ind AS 8 how to do retrospective treatments, 3 balance sheets, apply from earliest date when the financials were presented. All of that will have to be done. This means that the change should be treated as if the new presentation currency had always been the entity's presentation currency, with comparative amounts being restated into the new presentation currency. So this is change in functional currency. Disclosures, you can go through these disclosures, exchange differences, presentation currency, all this you can just go through it. Okay. All right. I leave this treatment of advance paid or received for homework. Basically, what is this is you are getting money as an advance. Advance is a monetary item or a non-monetary item. What do you think? You have received advance to give revenue in the future, to supply in the future. So is an advance a monetary item or a non-monetary item? What do you think? Advance is generally a non-monetary item. Why? Because it is not a determinable amount of money. It is a service that is going to be rented or goods that are going to be sent. Okay. So in respect of that, how to do the accounting, it's pretty straightforward. You can just go through this for homework. Okay. And there are two small questions. I think you should be able to resolve this. Okay. If you don't have any, if you have any issues, you let me know. In the next session, we can take this up for your understanding. Okay. But until then, I will park this aside for homework. Can you do this for homework? Yes.
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 You are receiving advance on one date, supplying services or goods on another date. How to do the accounting is something that you will have to go through. Okay, so that is done. And then I think we are left with one more thing for which I was mentioning that you need to know little bit of, yes, this one. See, this is how many you guys are comfortable with financial instruments, or still you are yet to study financial instruments?
Yet to study financial instruments.
Yet to study. What about others? Karthik, Bibhu, Geeta, Leela?
Yet to
We
Sir,
study.
haven't studied, sir.
yes to study.
Yet to study, right? So what I will do is I will take this up once you're in your LVRC or after your financial instruments is done. That time you can probably take this up. Or if you are okay, sir, whenever he takes, you can ask him as part of financial instruments. Let him see if he can do this particular question, or I will definitely be doing this question once your financial instruments topic is over. Okay. So with that, I think we broadly have concluded. Okay. So now if you look at these MCQs, I think you should be in a position to. Why is it not opening? Yeah. So I think these 2, 3 MCQs, you should be able to do it. Exchange difference. Okay, so question number 7. Exchange differences on a NIFO, net investment in foreign operation. Where do you recognize it? A, B, C, D. Where do I recognize that?
B.
B. Everybody?
Yes,
B.
B.
Yes. B. All right. Perfect. So 7B is the right answer. Number 8. If a foreign operation is disposed of, the cumulative translation differences in OCI, that is your FCTR. What do you do with that?
Transfer to retained earnings.
Reclassified
No,
to P&L, sir.
reclassify to P&L. See, effect is the same, Sanjay, but the route is important. From FCTR, ultimate destination is retained earnings. बट बीच में एक आता है ना P&L. P&L
Yes.
में आके यहाँ जाता है, right? So this
Yeah.
hits your P&L. Your profit goes up or down for the year. That should happen. Okay. All right. So reclassified to P&L. All right. Next. So this is done. This is done. All right. Next. In consolidation, the financial statements of a foreign subsidiary are translated into presentation currency using which rates?
B.
B. Closing rate for assets and liabilities, average rate for income and expenses. Exchange differences arising on translation of foreign subsidiaries financials. Where do you show that?
B.
B. Girls, you are able to follow, right? Yes. Geeta, Leela, this is done. This goes in OCI. If the functional currency changes, the entity should, what you should do? Restate comparatives, apply the new currency prospect,
Retrospectively, sir.
Retrospective effect.
apply the new currency retrospectively. Yes.
Retrospectively.
That means basically the question A and C both will happen. When you apply C, A also will happen automatically. maybe drafting में थोड़ा issue है, but yeah, it's essentially A and C both will happen, but C becomes the right answer because that is the first thing that you will do. As a follow-up to that, comparatives get restated. Okay, all right, fine. 15. 15. Foreign exchange gain or loss on equity instruments at FVOCI. It is at fair value through OCI, तो OCI में जाएगा. This is, we saw yesterday, right? If any item of exchange gain or loss is in the, if the original gain or loss is in the P&L, exchange gain or loss also will go in P&L. If something is in OCI, exchange gain or loss also will go in OCI. So that is your 15. If the foreign operation is integral, 16. Okay, this I think we don't have this. Okay, can
सर,
let us.
15th क्वेश्चन, इक्विटी इंस्ट्रूमेंट पे फॉरेन एक्सचेंज आ सकता है क्या?
Which one?
In 15th question on
Yes.
equity instruments, can there be any foreign exchange gain or loss since we are valuing it
course.
at on the date of acquisition date only?
Suppose you have invested in shares of Microsoft, then your fair value gain or loss will be in foreign currency, right?
Yes, sir.
So that is what it is talking about, right? So
From the investment perspective, sir.
yes, from equity instruments of foreign companies. Okay, fine. So a foreign currency transaction recorded initially at
Date of transaction.
date of transaction. Yes, that's it. All right, fine. ठीक है. I mean, this should take care of quite a number of your MCQs. Okay. So from my side, I think the standard is done. Only two things. One is that Appendix B, which you will do for homework. Second is that financial instruments. Both these things I can discuss it. The homework part, I'll surely discuss it in the next class. The financial instruments thing, I will do it once your financial instruments chapter is done. Okay? Or you can only do it after the financial instruments is done because principles are the same. Expenses will go on average rate, balances will go at closing rate, etc. etc. Okay? So you can take it in that sense. All right. So we stop here. If you have any doubts, let me know. Otherwise, we can conclude. Okay? We conclude?
Yes.
All right then. ठीक है. That's it. All the best. See you guys on, I think, 15th November now.
Yeah, thank you very much.
Thanks. Thank you. Thanks, everyone. Thank you. Please let me know your suggestions if you want any changes to the speed or the pace or the manner. You can give your honest feedback. Okay? Yeah. So if there is any shortcoming from my side, I will ensure that I address it immediately. Okay? All right. Okay. Thanks, everyone. Thank you.
Thanks.
Thank you. Yes, yes. Session concluded. Thanks. Thank you. Thanks.